So today our topic is behavioral econ. And I find this topic really interesting because economics for a long time was built on the assumption that people are rational and make good decisions, but otherwise we wouldn't have so many irrational crises, right? Like the 2008 financial crisis with home loans, with the 2001 dot-com bubble, or basically anytime there's been a stock market crash that is basically human induced. Okay, that's funny, it says names here. So today we'll be talking about behavioral econ, which studies the intersection of psychology, a bit of history, and a lot of econ finance. And it tries to explain why people do strange things and cause strange things in the market. But what you'll find here today is that a lot of the examples are a little bit more tailored towards microfinance or microeconomics rather than macroeconomics. And micro is more focused on your individual impact and your individual decisions with regarding finance, while macro is like the large scale, GDP economic indicators that we were studying in boot camps. So today we'll be talking about your individual decisions, and you'll probably find this much more I guess there's like a lower barrier to entry because you probably understand more of it. If you've ever shopped for anything in a capitalistic society, this will make sense to you. Yeah, so Matt, if you could send those podcast links in the chat. There were certain articles or podcasts that I was listening to when I got into this topic that I thought were really behavioral, beginner friendly. And so if you guys want to check those out, I totally suggest them. So yeah, we'll be going through a couple different topics. The names aren't all correct, but I'm pretty sure these topics all are, plus Griffin's. So some of these might make sense to you if you guys like to, play video games. Game theory might make sense. I've gone through noise before in boot camp, but that was like a really quick brush with it. A lot of these have really famous econ professors that go along with them. So if you guys are interested in studying econ in college and you ever study any of the papers or any of the books that these guys read, then that should be pretty relevant. And a lot of these are actually professors at really, really good schools. And that's kind of relevant for us seniors. So these are some names that you actually stumble across when doing your research on colleges. Okay. Just to check, who did information asymmetry? Okay, Shreya, are you able to unmute? Oh. Yeah, Shreya, why don't you try leaving and coming back in a second? We'll come back to your slides, so we'll skip over this for now. So let's go through prospect theory.
Okay, so the prospect theory is this observation that is made about the nature of humans when it comes to investing. And so this theory states that investors value gains and profits differently. It's not like a scale to them. It's profits are worth less and gains are, profits are worth less and losses are worth more, right? And so this helps the behavioral economists understand the intentions and the motives as to why they invest, rather than, okay, you're investing, good job, but why? It's like that big question of why do they do what they do. It's that's the fundamental thing about behavioral econ. Wait, give me a second. Sorry, my computer turned off. Okay, so when people are faced with a high risk choice, they don't take that risk. And when people are given a low risk choice, then they're more likely to take risks. So just as a small game, or just to prove this theory, I would like to pose a question. And that question is, would you rather get $1,000 with 100% certainty, or $2,500 with a 50% chance certainty? So which one would you choose? Like, just put into the chat option one or two. One is $1,000 with 100% certainty, or $2,500 with the 50% chance. Okay, so now from what we have here, many people would like $1,000 with 100% chance of getting it, right? Because you don't you don't have to deal with that uh, loss if you don't get it, right? But then the 2,500 chance, even though there is a higher risk, and people say that in the market and and yeah, sorry, people say in the market that, oh, higher risk, higher reward and all that, but many people aren't that willing to take a risk, right? Because that $1,000 is just enough for them. They don't need to play around with their luck. And here's another scenario in the exact opposite. So would you rather lose $1,000, and that would be certain, 100% chance, or would you have a 50% chance of either no loss or $2,500 loss? So option one is you would lose $1,000, 100% chance, and option two is 50% chance of no loss, or uh, $2,500 loss. So you can populate the chat again, as teachers say. Okay, so now from what we have here, we have it's really close, but it is uh, a few more twos than ones, and that's basically the prospect theory. Uh, you would rather have no loss, or sorry, you would rather play with your chance in that case, where it would either be no loss or $2,500 loss, and you're willing to take that risk because there's still that chance where you don't lose any money. And that's the thing. Ideally, or not ideally, theoretically, uh, you should have answered one and one in both cases, or two and two, the same option in both cases, and uh, that would show equal judgment. But in this case, we can see that we weigh losses uh, differently than profits. And the man behind this is give me a second, Daniel Kahneman. The name is cut off the subtitle. It's under here, but it's Daniel Kahneman, and he proposed this theory. So that's it. Thank you.
So, adverse selection is when there's informational asymmetry, and when there's a person more knowledgeable about the product, they exploit it. And so, basically, there's many different examples. So, for example, a car salesman sells a buyer 11, which is a used car with problems, at the price of a peach, which is a new good car. Another example would be if you have a smoker who doesn't exercise and a non-smoker athlete who both need health insurance. The smoker most likely would lie to get lower health insurance premium with the same benefits.
Hi, so bounded rationality is just an idea of rationality proposed by Herbert A. Simon, and the way he describes it is he uses the analogy of a scissors, where one blade is the cognitive limitations of humans, and the other blade is like the structure of the environment, and how this explains how humans utilize the structure of their environments to make up for the lack of sharpness of their cognitive limitations. So what does this mean for behavioral economics? It just relates to how um, most of the time in humans, rather than analyzing the full cost benefit, people will normally take shortcuts that may lead to suboptimal decision making. So this behavioral economists map decision shortcuts that people normally use to help increase the effectiveness of decision making based on the social market. Thanks.
This is mine. So I realize this is kind of actually pretty general and kind of similar to just behavioral econ in general, but behavioral game theory basically takes traditional game theory and puts a spin on it. Uh, I'm sure some of you have heard of game theory, or not all of you. Like, it's a pretty common thing. Like, I think it's become popularized through like weird like TV shows. What is it called? Like the brain games or whatever. But anyways, basically it's the idea that people will act rationally and use that rationally, the rational acting to like create hypothetical scenarios to see how rational actors would ultimately act in order to maximize the utility for themselves. But behavioral game theory is like, well, that's not really what actually happens in real life. We're not always rational. If we were, that actually kind of sucked. But I mean, besides the point. So it kind of tries to analyze what exactly differs between real life and this ideal traditional game theory world. So they identify, well, the article I read identifies 4 main factors that allow people or influence people to differ from traditional game theory and exact rational acting. So I highlight them down here, but you start with beliefs. So it's kind of like internalized beliefs that aren't necessarily rational. You could point to a lot of them, like religion or just personal, like moral conduct or codes. But the one that the article pointed out was rational actors don't underestimate their opponents, but we might. So if I'm an investor or something, I might underestimate the ability of my opponents to pick up on the same trends that I do. So I assume that I'm going to get the lead when I don't really. So basically, rational acting assumes that we have this kind of baseline level of knowledge and objectiveness that we don't actually have. Another factor is social cooperation. So I kind of touched on moral codes just now, but social cooperation is this idea that we don't always act in self-interest, and a lot of times social norms impact us as well. You could think about like, I have this example later of the prisoner's dilemma that I'll present, but like you could think about like anti-snitch codes, right? Like like people don't like snitching on other people. That's an example of social cooperation and social norms that restrict you from doing things that might be in your complete self-interest. And also includes things like what is fair, what is just. Yeah. And then deception. This is kind of similar to belief, but not exactly. It's like when you start out with a faulty premise and that causes you to make irrational decisions. I forgot the exact example they gave, but like they were talking about how, oh right, if you are winning, like if you're gambling, for example, and you win a couple slot machines, like a couple pulls, then you'll be incentivized to keep going. And these incentives aren't necessarily rational, but they do impact us, right? If you win a lot, you want to keep going to keep winning. Or maybe you want to stop, like, most times you want to keep going. If you lose a lot, you want to make up your money, right? If you go to a casino, you lose like $500, you're like, I could do one more and win it all back. So that's deception. And finally, yeah, and then finally grouping. So this is actually not, this factor doesn't cause people to deviate from traditional game theory, but it causes people to move closer to it. When we're in large groups, the first 3 factors we talked about, so beliefs, social cooperation, deception, they're less evident. So like because your social codes and your irrationality is kind of balanced out by the group. So you make more rational decisions. So the larger the group it is, the more rational your decisions are. Controlling for practicality, if you have like 1,000 people in a room, I'm sure there's gonna be some difficulties, but yeah. Next slide. I have an example. So I'm pretty sure like a lot of you, or not all of you, have heard of the prisoner's dilemma. Like I said, pop culture has popularized it, but the idea is, well, you and your partner in crime have gotten prosecuted for a crime, and you have the option of either confessing or not confessing. And depending on what you do and your partner does, you'll have different sentences. If you both confess, then you each get 5 years. If you each remain silent, you get 2 years. And if one of you confesses and one of you doesn't confess, the person who confesses actually only gets 1 year. There's a lot of different deviations. These are the numbers I chose, but I guess in the chat, like, which one would you choose? I'm sure a lot of you know the correct answer, but I'm just curious, which one would you choose? Would you confess or would you stay silent? Please don't leave me hanging. Silent. So most of you guys have moral codes, and some of you are like total cutthroat businessmen that I would not want to be friends with. But including you, Colleen, I don't know, we're not friends anymore. But yeah, so for those of you who said confess. Okay, why are you guys trying to? Okay, not it's it's literally just Colleen. Colleen's just trying to be funny. Come on, if you confess, it's technically the correct way to go, right? Because I'm sure I have to explain this for anyone who doesn't know, but I'm sure a lot of you do know. If you isolate for one prisoner, so let's assume we're just prisoner A, and you isolate for each different option you could have if prisoner B, what prisoner B does, it ultimately works out in your favor if you confess every time. So what's under your control is whether you confess or not, right? So let's assume that prisoner B does confess. So if you don't confess and you remain silent, you get 8 years in prison. But if you do, you get 5 years. So it's to your benefit to confess. But then if prisoner B remains silent, it's still in your benefit to confess, because if you don't confess, you get 2 years. But if you do confess, you get 1 year, right? So theoretically, in complete self-interest, you would confess every single time. But yeah. But I hope you wouldn't do that, because that's snitching. You're kind of a bad person. Just don't snitch, man. So, like, this is an example of kind of the social cooperation thing. You have a tendency to value things like justice or fairness or camaraderie, and this impacts your decision to make rational decisions, and it kind of turns traditional game theory on its head. Yeah, I'm done with that.
All right, the next behavioral econ topic we're going to go to is irrational exuberance. In other words, not rational excitement. It's pretty self-explanatory. It's in the name itself. If you're wondering why there's bubbles in the background of this slide, we'll get to that. So basically what irrational exuberance is, the basic definition is that it is unfounded market optimism that lacks a real foundation of fundamental valuation, but instead rests on psychological factors. So really, it's just widespread and excessive economic optimism. So what that means is that when investors start believing that a certain rise in prices, whether it's like a security or an asset that predicts in the recent past predicts the future, so they're like almost acting as if there's no uncertainty in the market. There's no volatility at all. So this creates sort of like this perpetual positive cycle of even higher prices. And if that sounds familiar, that's because that is one of the primary reasons why we have bubbles in asset prices. But when, if you guys don't know what a bubble is, it's basically when a bubble is an economic cycle that is characterized by like rapid escalation in market value. But when that bubble bursts, because bubble do burst, investors quickly turn to panic selling, in which when the price finally declines, uh, the the stockholders are more inclined to sell their assets for less than they're worth based on the fundamentals. So when that happens, this continuation of selling and buying or selling overall creates could cause a recession, and that's actually what happened in the late 1990s dot-com bubble. If we go to the next slide, we can see on this graph this cycle of irrational exuberance starting from the 1994 peaking all the way up to 2000, and when people start to finally sell, that's when the panic selling starts and it goes into a recession. So it actually fell by over 76%. So really, the investors who get hit the hardest are the ones who are still all in just before the correction. So, and those are the overconfident ones who are sure that the bull run will last forever. If you fall into the trap of irrational exuberance and trust the bull too much, that is one way for yourself to get eviscerated by the bubble burst. So if we go to the next slide, Robert Schiller, who, if that name sounds familiar, is actually one of the professors at Yale who taught the financial markets course that we've stressed a lot. It's actually a really good course. Against this is like my 100th time mentioning it, but you guys should totally take it. He also wrote a book on literally called Irrational Exuberance, which analyzes the broader stock market boom that lasted from the 80s all the way to the dot-com years. So he presents like 12 factors that created this boom and suggests like different policy changes for better managing this irrational exuberance. He also released a second version published in 2005, which warns of the housing bubble burst, which ended up occurring 3 years later in 2008 and led to the Great Recession. So irrational exuberance is, in short, is definitely one of the most primary factors of the creation of bubbles, and it's something that's worth checking up on.
Yeah, I did this one too. So, nudge theory, um, kind of like I think it's kind of like 1984 stuff. That's fine. Basically, it's the idea that you can change small things in the environment, yeah, and change people's decisions. So, like, companies do this all the time. Even the government does this all the time. But basically, it's not like enforcing anyone to do anything or enacting a punishment or something. But it is just small, like very almost unnoticeable changes that cause subliminal reactions in people that cause them to act in certain ways. So the article I read identified 3 types of nudges. There's probably more, but there's 3 specific examples. Default changes. So basically, if you're given 2 options, you're always more likely to choose the default if there is a default. The example of this that I guess I came up with was organ donors. If you have an organ donor option, like you opt in or opt out of organ donors, you find that countries that have an opt out option of organ donors, so you have to specifically file papers to not be an organ donor, find that people are more likely to become organ donors. Example being Spain, who has an opt out system and has one of the highest organ donor rates in the world. So if you change the default, people are more likely to choose the default. I'm pretty sure this taps on like the innate laziness of people who just don't care enough to change. But yeah, social proof heuristic is the idea that people tend to look to others for choices. So like advertisements, no one's telling you have to do it, but if everyone else is doing it, why don't you do it too, right? So that's that. And attention. So if you highlight an option more than other options, people are more likely to choose it. So if you don't like, if you have a multiple choice test or not a test, a survey, but one option is like highlighted and bolded and like whatever, people are probably going to be more likely to choose it just because their eyes are drawn to it. Especially there's a ton of options, right? So it doesn't change anything substantive about the answer, but it make people choose it more often. So these are 3 examples of nudges. So things that aren't coercive, but they do impact people to do certain things. And this nudge theory kind of falls into this broader umbrella of, like, I think it's almost philosophical, like libertarian paternalism, that you can change behaviors without actually obstructing their freedom of choice or being like, I guess I'm doing concepts, so tyrannical or despotic, right? Like you can influence people's behaviors without being like super upfront and like just crazy about it. Like you can just make small changes and people will change their behavior as well. So, and this also falls in the broad theory of choice architecture. So like how to design surveys, how to design choices so that people will choose certain, like, will act the way you want them to act. Without being coercive or punishing or something. The example I found really funny, because I can, actually, I don't know if I should say that, but I found it really funny, was the traditional example of the fly on the urinal to increase aim. If you put a fly on the urinal, like at the back, people are more likely to aim for it. I thought that was I can't say that word. I thought it was a brilliant example, and I thought it was really true. So it's like it doesn't actually coerce you to like do anything. I can't say the words, but like to do anything. But it does actually change your behavior and influence you to act a certain way. So on the right, there's a picture of that Richard Thaler guy. I found a picture of him with like a medal around his neck. I don't know. I thought he looked pretty sick, so I used that one. And the bottom picture is the book cover, and you show a little elephant nudging its kid. So it's like, I guess you could almost equivocate it to how parents raise their children. Hopefully they don't like enforce very strict punishments or do or die things, but they do try to encourage you to act in the correct direction by setting up certain scenarios that would encourage you to do so, or correct. In this case, it's economics. So, you know, we're trying to get people to buy stuff, which is less good, but I guess still works.
Isn't that the Nobel Prize?
I don't know. I guess so. But like, I just thought he looked cool with the medal and all. There was like a picture of him without a medal. And there was a picture with a medal. I was like, he's got way more
That's
drip.
right?
I don't know. He looks like he's got more drip with the medal on. You know what I'm saying? He looks cooler.
Yeah.
Yeah.
Yeah. Okay. Yeah, that's nudge theory. And then noise. So this is my topic today. Okay. I did introduce noise a little bit earlier in our economic indicators bootcamp number 3. So this is a concept that a lot of people don't like to talk about because there's no easy way to solve it, and it's kind of necessary and inherent to the system. What I mean by that is noise is basically any information that misrepresents or distorts a trend. So you should not listen to noise, but sometimes you can't help it. And noise is contrasted with information. So information is what is the good things that people listen to when they want to make a decision on anything, but in this case, we would talk about the stock market. Noise are all of those little changes that people think are a big deal, but they actually aren't. They think that it means that it's a trend, but really it's not. And because of that, they might buy into something or maybe not buy into something, in which case would obviously have a good or bad impact that was unintended. So some causes are program trading, which is basically like when you use a computer algorithm to do it, and the computer can't always detect whether the trend was right or not. So that's how it would distort or misrepresent a trend. And it would just it basically conducts like technical analysis, right? Generates some data, but the data is not necessarily always like for a good reason. And then dividend payments, if you guys remember, dividends are like basically the cash payments that companies give to investors to ensure that they'll continue investing, right? It's like incentive basically. And that's not, it's a good thing, right? If you're an investor, you want money, but at the same time, that means they're not using that money on bettering their product or increasing their stock value. Or maybe that's just not necessarily a good company, but it's all subjective. And so some effects of noise would be short-term volatility, right? Which means that volatility, it moves up and down a lot, right? The stock, price moves, correction in this case, meeting ends in 10 minutes. I think we'll finish in 10. If not, we'll restart. But with volatility, correction, basically the stock is typically too high of a price and it's not actually at that value, right? So we would call that overvalued, if you guys remember that. And so what happens is the price corrects itself to like from here to like a lower amount, in which case usually around like 10%, I think, is the correction percentage. And in that case, that would be like noise because that's just like a lot of unnecessary movement. But yeah, this leads to speculative trading and market inefficiency. Kind of intuitive, right? Those definitions. And this is usually based on hearsay, news, rumors, and it's reactionary. It's not really for a good reason. Fisher Black, I think, termed the thing noise in his theory of pricing. So in the short term, noise is really hard to distinguish from information because you don't know what the trend is in the short term. You're just guessing. And if any of you have made mistakes with trends in the stock market game yet, or maybe the real stock market, I hope you haven't. But if you have, then yeah, that would probably be a reason you misidentified a noise from a real trend. And as for long term, it's easy to identify the trend because hindsight, right? You can tell, oh yeah, that was a good buy. Tesla really did go up for that whole time. And the signal to noise ratio is something I'll talk about in the next slide. But signal is basically good information. Noise is bad information. So here you basically have the noise v signal. With the top graph, you'll see positive and negative noise. And by that, it just means how much noise, I guess, the S&P 500 had at that point. And then you'll see with signal and noise. So signal is something that has a right answer. Signal is it's a concrete data point. It's like CPI, or Consumer Price Index, GDP, those kind of economic signals or indicators are things that are correct information. Noise are like all those things in red that you see, right? There's like North Korea, China trade war, inflation jump, 3% bond yield. They're not real good reasons for a trend to continue, but they do anyway because people are irrational. We've pointed that out many times already, but people make things, make decisions on a whim. All right, okay. This is an activity that we might not have time for, but basically it's what Kahneman, if you guys remember Daniel Kahneman from Gyan's slide, hold on. I have his book because I'm a nerd, so Kahneman's really cool. Anyway, Daniel Kahneman has an exercise in judgment. So the next topic is basically judgment versus intuition. So judgment is something that is usually a longer period of time in which you basically assess something either ahead of time or afterward. Intuition is like, you know, it's something that you think of on the whim and you're like, okay, I think that I'm going to go with my gut. And it can be pretty disastrous to go with intuition. You might think, oh no, I have a pretty good intuition, right? I think I remember Colleen saying like, I have pretty good luck. Well, that's false. Like most people don't really have good intuition and you really should not rely on that. But Kahneman's exercise in judgment is when you're nearing the end of a deliberation, you should discuss this with your team. In a hypothetical situation, 2 years after you made the decision is revealed to be disastrous. And so you ask yourself, what happened, right? Because you want to always think of like the worst possible case scenario. So if you guys have ever had like a postmortem, that's like a really fancy way of saying like, you know, after the thing happens, after the event happens, like you have a meeting and you discuss, was that a good thing or a bad thing or what things went well? I'm sure you do this in like clubs or like presentations or whatever. And so a pre-mortem is like the opposite of a post-mortem, right? You just do it beforehand, before the disaster happens. Okay, and so with this slide, it's basically evaluating intuition and judgment. So there's a couple diamonds on the screen that you'll see that basically tell you things you should watch out for to make a good, wisely judged choice. So first of all, when you evaluate options, you should always evaluate them independently, according to Kahneman, which means like you should not be evaluating things relatively because it actually creates more potential for subjectivity. So in this case, his really good analogy is like, if you have a bunch of witnesses, you don't want them to talk to each other, right? Because like with Derry's prisoner's dilemma, they don't get to talk to each other. You just like individually, you isolate them and you ask them for the truth or whatever if they lie. So like you don't want witnesses to talk to each other beforehand because that obstructs truth. Yeah, protect the dissenters because those are the most valuable opinions. If you guys have taken AP Psych or maybe just like, you know, lived, you probably know the term echo chamber, or at least you have, or maybe groupthink, right? Those are basically the same thing. An echo chamber is when you and a bunch of other people who are like-minded, or maybe not like-minded, but you don't want to disagree, you guys all just keep like hyping each other up on this one really bad decision, but you don't realize it's a bad decision, or you just don't feel comfortable with sharing, in which case you go down this spiral of bad decisions. And with groupthink, it's basically the same thing. Okay, lastly, second to last, you want to write your intuition down before the discussion so you know what you intuitively thought. Then you go into the discussion and you don't go back because with your memory, this is also psychology, but memory is really, really unreliable. You think you remember what you said or did, but you probably don't. You probably misconstrued it or misremembered it. So this is another thing where you want to make sure that you have a written record of your intuition before going into the meeting. Once you go into the meeting, you want to rationalize and defend your opinion, maybe even change it, but you don't want to go into the meeting with like, oh, I think I thought this. And then afterward you go like, oh wait, Derry had this way better opinion. Let's just say that was mine. And then your brain actually rewrites itself. It reprograms itself to think, yeah, Derry's opinion. That's what I thought to begin with. But that's not necessarily true. And with the last diamond, just keep a decision journal, just track your decisions. And this might seem like, you know, like I'm not really into journaling kind of thing, but like if you're into like things that make a lot of decisions, like if you want to do finance as a career, this is definitely a good idea. Oh, lastly, clear versus strong intuition. The clear decision is an obvious decision. You're like that, like I clearly want more money and not, or I clearly want to gain and not a loss. Or maybe like I clearly like the color yellow more than the color green. And if you don't feel particularly strong about something, that means that you don't really care that much. And that's just like a small little thing. I'm not really sure why I included that. I just thought it was cool.
Yeah, so the framing effect is the idea that one's decisions can be manipulated through biased wording or the framing around it. And this is often used to advertise and to sell products. And I didn't realize that loss aversion was already covered, so I'll just skip it. But loss aversion can be used to bait people into spending more. Like for instance, in this chart below, like people tend to end up with more toppings when they subtract toppings from like a fully decked out pizza than when they subtract or from when they add toppings, because people want to avoid losing the toppings more than they want to gain toppings. And another example of the framing effect would be psychological pricing, where certain numbers can change perceptions of price. And a very common use of this would be like putting $99 instead of $100 to like trick the consumer into thinking it's like a lot cheaper because it's like it doesn't look like $100 or like 3 digits. And also the decoy effect. This can be used by adding like a decoy option. So like in the example below, the large option seems like a much better deal because it's only $1 more than the medium option. It's probably much bigger, and they don't really want you to buy the medium option, but like it's just there to make the large option look a lot more appealing.
Yeah, and this is essentially the way every single fast food restaurant operates. Okay, and I believe this is the last slide, so I'm going to go back to the beginning, and here's information asymmetry for the last minute before we break.
So information asymmetry is the idea that in an economic reaction, which is buying and selling, one side would have more information than the other on a product. And George Apropos, who is an American economist, introduced this in his Nobel Prize-winning paper, Market Lemons. So what he did was he used the used car market as a model where used cars with problems are lemons and new or better cars are peaches. And what he said was that the there's a buyer and a buyer wants to buy a used car, but the buyer doesn't know which car is lemons and which are peaches, so they would offer the price of a lemon for any car because they don't want to take a risk. So if the car is a lemon, the seller would most probably agree because it is a fair price. But if it's a peach, the seller will not agree because they're losing money, and they will most likely get more offers like this and take the car off the market. And this can actually result in market failure because